Hello there, my name is Elliot Wonenika and welcome to part 2 of our relevant costing lecture. So in part 1, we introduced the concept of relevant costing and how it links to various decision-making processes. So in this lecture, we're going now to focus on various examples in which we apply relevant costing principles. So the first one is around replacement of equipment. And the question here is, are book values relevant? So to answer that particular question, you may need to ask yourself, what is book value? So book value is equal to the cost of acquiring the equipment less the accumulated depreciation. So effectively, book value is a process which is used in accounting to allocate the cost of the equipment over the life of the equipment, which therefore means effectively book value is a function of the cost of the equipment. And if you remember, the cost of equipment is a classical example of a sunk cost, which means it is therefore not a relevant cost for the decision-making process of whether or not we should replace old equipment. Because whether we replace or we buy or we don't replace, the book value cost is not going to change. Anyway, and the other question now is on around how do we treat all the equipment with disposal values. So the question here is, if we take the alternative A of not replacing the equipment, we're not going to dispose. But if we go take the decision to replace the equipment, we are going to sell the old equipment and get some cash inflows, which therefore means the disposal route will only occur if we buy the new equipment. Therefore, the inflows from the disposal become a relevant cost. Okay. Then another classical decision that is interesting where we apply relevant costing principles is where we want to make a decision whether to produce in-house or to outsource. And in terms of comparing those two decisions, we can then do a quantitative analysis. What is the cost of making in-house versus the cost of outsourcing? And we are saying here we need to take the cheaper option. That is based on a quantitative analysis. But the question now is, in determining the cost of making in-house or in determining the cost of outsourcing, what are the relevant costs? Biggest question. So it means, as an example, if we are going to make in-house, what are the costs? Is the fixed cost therefore relevant? So in the short term, we can then say, if we are going to make in-house, whether or not we produce, we are still going to incur fixed costs in the short term. So for the purposes of comparison, fixed costs therefore become an irrelevant cost. But we are saying whether or not we make or outsource, we are still going to incur those fixed costs. So for this decision, not relevant. Or another question that comes into play is, if you go the route of outsourcing, because we are now outsourcing, what's going to happen to the capacity that we are using to produce now? So that capacity can have alternative use. As an example, the X-release capacity, let's say it's a warehouse that we use to store some of our manufactured products. Now that we are outsourcing, that warehouse is now excess capacity. And if you've got an option to sublease that warehouse, it means you may get rental income. So it means that rental income then becomes a relevant cash flow for the option of outsourcing, which therefore reduces the cost of outsourcing. So ultimately, when we then analyze the two options, we are saying we've taken into account all the relevant cash flows for the two options. Then we take the one with the lower cost. However, over and above this quantitative analysis, we also need to consider other qualitative factors in that decision-making process. So if you are going to outsource, what other considerations do we make? Is the price from our supplier going to remain constant? What is the going concern of the status of the supply? Because if the supplier is going to shut shop, what is it going to mean to our own operations? So those are now other qualitative factors. But more often than not in your examinations, you also be asked to provide other considerations relevant to that decision you want to make, which are above and beyond the quantitative analysis. Then another decision is on discontinuing decisions. Should we continue with operations or should we stop with the operations? So this one has got so many similarities with the make or buy. Because if I'm making, I'm continuing. If I'm buying, I'm discontinuing what I'm doing and then outsourcing whatever I was currently doing. So the principles around that would be more or less exactly the same. Then we go to our direct costs. So ordinarily, we work with the assumption that direct costs are relevant costs. But that assumption does not always hold water, especially where we take materials from existing inventory. Yes, the original cost of buying the material is a sunk cost. So that original cost is not relevant. So we've got a number of questions they need to be able to raise. The first one being, does the material have other alternative use? If the material has got no other alternative use, it means the material taken from existing inventory, they're not a relevant cost. But if the material needs to be replaced, say we have taken it, but we need to replace it, it means the replacement cost then becomes the relevant cost. The another scenario is the material that we have taken from existing inventory has got a resale value. To say if we don't use it for this project, we could have sold it and earned some income. But if you go ahead with this project, we're not going to be able to sell. So the foregone income then becomes the opportunity cost of taking on this new project. So the opportunity cost therefore becomes a relevant cost of direct materials. Then direct labor is the same scenario again. Relevant cost of direct labor, ordinarily take it as direct labor is being relevant, but in some situations it may not be relevant. Say for example, with temporary spare capacity. So for a decision in the short term, this spare capacity, whether or not we take this project, we are still going to incur those direct labor costs, which means in the short term, the direct labor cost, if we go spare capacity, will not be a relevant cost. But if we've got casual labor, part-time labor, who we employ as and when we need, it means if we are going to take this alternative, we then need to bring in the casual labor, which means their cost becomes the relevant cost for that decision we would want to make. The another scenario is where we are operating at full capacity. And if we take on this new order, we need to take some capacity from current production to be able to fund the new order we want to produce. Which means here effectively we now have with a limiting factor, being availability of labor hours, which therefore brings into play constraint optimization principles, which we are going to cover in detail in the lecture on constraint optimization in decision making. So I encourage you, after going through this lecture, to read through chapter 9 in management cost accounting textbook by Colin Drury to get further insights around the principles on relevant costing. But what I want to emphasize is, in the examination, you are never going to get a required which is going to say calculate relevant costing, but we are going to get questions on decisions that need to be made. Should we accept the offer that has been made? So in analyzing or evaluating, your quantitative analysis then takes into account relevant costing principles. Or you are doing a capital budgeting problem. You are in capital budgeting, you're now looking at a more longer term time horizon. So we are still going to, again, to apply relevant costing principles within that particular context. So once you are done with the textbook, please go to your module, read your course notes on relevant costing, attempt the online quiz as well the practice questions in the module, then identify any issue that you may be struggling with around relevant costing and bring this to our next lecture session so that at least we can discuss and provide clarifications on any particular gray areas. For further information, please do make sure to contact the Manfin department on the email addresses provided. Once again, thank you very much for taking time to watch this lecture recording. Good day.